Good afternoon, everyone. Today, we raised our target range for the short-term interest rates by another quarter of a percentage point.
The Federal Reserve raised its key borrowing costs for the fourth time this month as it responds to a strong economy. The response in the markets was not so positive. Equity markets sold off after the decision. There was a lot of pressure going into this rates decision on the Federal Reserve not to lift interest rates. That came from both equity investors and also the President, who's been repeatedly calling on Fed Chairman Jay Powell to leave borrowing costs unchanged.
In early 2018, we saw a rising trajectory for growth. Today, instead, we see growth moderating ahead.
However, part of the outlook from the Fed was for a slower pace of rate rises in 2019 and 2020, and for Fed rate rises to lead to its key borrowing costs leveling out at a slightly lower level than had previously been expected. The Fed is broadly saying that the economy remains strong. However, it is also taking into account a growing number of risks overseas. They could include a whole range of issues, including Brexit, and slower economic growth in countries like China and other factors. So those cross currents, as the Fed calls them, are beginning to affect its outlook. It's trying to tread a delicate balance between tightening the cost of borrowing very gradually and very carefully in response to a strong US economy, but also taking into account hazards which lie ahead.
We think this move was appropriate for what is a very healthy economy.